Basel Bank lending regulations have given progressively lower risk weightings to real estate lending, and this has continued despite the 2007-2008 subprime mortgage crisis. Today we explore a very sinister trend threatening the middle classes of the Western world. So let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy. So please do consider subscribing. Now, these bank regulations have gone a long way towards ensuring house prices in developed nations have skyrocketed, and as credit has just expanded rapidly to real estate. But more worryingly, it has fueled unsustainable boom-bust economics. And an even more worrying trend is becoming deeply apparent, and which seemingly fits perfectly with the plans of the governing elite and their reset agenda, and that is the rise of massive privately provided rental housing. Take, for example, that between 2007 and 2017, the United States added less than 1 million households in owner-occupied homes, but 6.5 million were added to the renter-occupied homes. Many families wanted to live in a spacious house in a good school district, but could no longer afford to do so as the owners. The home ownership rate bottomed out at 62.9% in 2016, down from a high of 69% in 2005. Following the 2008 financial crisis, super low interest rates, enormous rounds of quantitative easing have swelled asset markets, and a flood of mortgage credit allowed house prices to take off once more. And this favoured the new Wall Street landlords, who had actually helped to generate the financial crisis in the first place. As this Atlantic article makes clear by stating that some of the same investment firms that had played a part in the housing crisis were now poised to profit from it. It made for a dismal irony. Yet now we are seeing a swathe of financial institutions move into the private real estate market globally. As the Wall Street Journal reports, meet your new landlord, Wall Street. Meanwhile, in the UK, Lloyds Banking Group has announced that they wish to become private landlords, which will involve buying out and renting new and existing housing stock across the UK. The commercial reasons for such decisions seem fairly obvious. Take, for instance, an environment of ultra-low interest rates, easy credit, and the potential threat to commercial banks' business model, courtesy of central banks and their forthcoming CBDCs. This means that such banks should seek to adapt their business model, and that perhaps is understandable. Yet this field is also attractive due to the massive support offered to propping up the housing market by central banks. Indeed, we've seen real estate prices continue to surge since the outbreak of the corona crisis last year. In the UK, one of the most important reasons for the surging volume of residential property transactions is the support provided by the Bank of England and the UK government to property buyers and investors. In mid-March 2020, as it grappled with the early fallout from the crisis, the central bank slashed the UK's base interest rate from 0.75% down to 0.1%. The rate cut was in response to the economic stress caused by the shutdown of the UK economy and the lockdown policy. And the falling mortgage rates have stoked demand for housing quite substantially. The government too has pursued policies aimed at inflating the housing market and propping up the mortgage lending industry. First, it introduced a stamp duty holiday that was supposed to end at the end of March, but was then extended at the last minute till the end of June. This has driven much of the recent surge in new mortgages. Consequently, mortgage lending in the UK has never ever been higher before. Net mortgage borrowing in the UK hit £11.8 billion in March, the strongest since the series began in 1993, according to Bank of England data. But now our government is going the full hog and offering to subsidise mortgages with 5% down payments for first-time buyers. Banks such as Lloyds, Santander, Barclays, HSBC and NatWest are already offering mortgages, and they're already slashing mortgage rates. Presumably they are also loosening their lending standards. After all, this time it's the government's problem, not theirs, if a borrower defaults. But no cost is too high when it comes to sustaining the UK's all-important housing bubble, it seems. Now, the prospect of rising house prices and their rental yields are promoting a new form of investing among pension funds, though, and online property investors through platforms like Fundrise, as the Wall Street Journal reports here. And so now it seems that financial institutions' interest in real estate markets is taking a more sinister turn, as the Wall Street Journal reports. And so Blackrock, pension funds and corporations are buying all the single family houses that they can find and are willing to pay 20 to 50% above the asking price to do so. The consequence of this seems deeply worrying, as entire neighbourhoods can be bought out from under the noses of the middle classes to offer back to the populace as single family rentals. After all, 20 to 50% above market value, who would say no? One of the key reasons why this is such a worrying trend, though, is that home equity has long acted as a key means of building and securing family wealth, while the likes of Blackrock and Lloyds over here are fully backed up by the central banks. In an excellent Twitter thread on this concept, linked below, Cultural Husbandry identifies this as a fundamental reorganisation of society. Once again, we see monetary policy being used for structural transformation. Now, independent journalist Jordan Schnackdal made an excellent comment here, saying BlackRock is buying up property in a risk-free environment that has been created for them by the ruling class, a protection racket for the elites in DC and Wall Street. Problem is, not just politicians, but a Federal Reserve enabling them with unlimited credit. Our money is the problem. He goes on to say, on a Bitcoin standard, or on a gold standard for that matter, BlackRock would not be able to make these magic money printer pack purchases. Their ties to the CCP and to our ruling class would be irrelevant, because they would not be able to weaponize the financial system to their advantage. I wholeheartedly agree. This is why we must champion the cause of sound money. Consider where it will leave the average middle class person in 30 years' time. Ultimately, a serf in a feudal society. BlackRock alone could be able to buy an estimated 30,000 homes per year. And just remember that financial institutions benefit from all sorts of explicit or implicit guarantees that encourage them to behave recklessly. They're backstopped ultimately by the government and the central bank and their fiat Ponzi scheme. This process, clearly part of Klaus's Great Reset plan, is one that we must stop in its tracks. I think it's absolutely imperative that we make sure that we manage our money well, that we borrow within our means so that we do not increase our leverage too much, and we make sure that we concentrate on building wealth. Precious metals are of course a wonderful starting point, and to that end, supporting silver squeeze, something I see as a massively important movement. Let's bring these corrupt institutions down before they can roll out the next part of their Great Reset. Ultimately, we know what's coming. It's a controlled demolition of the entire economy, and then the rollout of the central bank digital currency. I hope this has been a useful video. Thanks so much for watching, and I look forward to seeing you next time. Bye bye.